Boot camp, let's go. All right, I have to get through the disclaimer real quick. So if you have your phone on or your YouTube tab open or whatever, go ahead and close those while I'm going through this. This content, as always, is going to be for educational purposes only. All examples and analysis are intended for these purposes. They shouldn't be considered as specific investment or trading advice. All hypothetical examples that we cover tonight are going to be for the purposes of teaching principles only. They're not intended to suggest any future results. The risk of loss in trading securities, such as equities, options, futures, and Forex, can be substantial. So you guys have to consider all relevant risk factors, including your own personal financial situation before trading. Options, futures, and Forex are considered more sophisticated investment vehicles due to high leverage. They're not suitable for everybody. Any results that I share tonight should not be considered typical. Alrighty, welcome to boot camp. So today, we are embarking on day one of your options trading journey. We're starting here. We have kind of this roadmap where we're climbing the options trading mountain. So we're starting down here, basically at base camp. I guess my analogy is kind of getting crossed here. Base camp / boot camp. I guess boot camp is more of an army thing and base camp is more of a mountain climbing thing. But you know what? We're doing both. We're in the army and we're climbing mountains. So that's just how we trade options. So we're starting in base camp for boot camp here on day one. And then we're going to move up to day 2, 3, and 4, and we're going to summit this mountain as we go along. Okay, so where are we? Those of you that are familiar with the, the competence hierarchy, I believe it's called. Basically, what this is this is kind of a model of learning that humans do. So when you don't know something, you're in this stage here of unconscious incompetence. And this is basically where you just don't know what you don't know. You've never been exposed to a concept. You don't know anything about it. And so you are unconscious about the topic. And so you are incompetent in that topic, right? You don't know anything about it. You don't know that you don't know anything about it. You're just completely unconscious about it. The next step is conscious incompetence. And this was where you're familiar with something, you know that it exists, but you don't know anything about it. And this is basically what we got you to with the webinar. The webinar was to show you guys, here's what options trading is, here's what it can do. You're aware of it now, but you don't know how to trade options yet, right? So boot camp is designed to take you from conscious incompetence here up to the next level where you are consciously competent, okay? Meaning that you know about options trading, and now you are competent, you know how to trade options. The next level after that is unconscious competence. And unconscious competence is kind of like that flow state where you are familiar enough with something, you do it enough that it just becomes unconscious. You don't have to think about it, right? And I can't get you to unconscious competence. That is something that you have to get yourself to from practice, okay? This just takes practice and repetition. You can't learn unconscious competence. So as much as I would love to be able to sell you a class that gets you to unconscious competence, I can't. So this is a journey that you have to take yourself. I can get you from unconscious to conscious incompetence. I can take you from conscious incompetence to conscious competence, but you have to take yourself the last step. So bootcamp is here to get you to the point where you know about options trading and you know how to trade options. And then the rest of the journey is for you to just practice options trading, okay? And again, I can't practice for you, so that last step has to be taken by you. But are we all on board for this? This is where we're getting to. By the end of this week, you will be consciously competent in the topic of options trading. You will understand how options work. You will know how to trade options. And you'll be able to do it yourself so that you can then get yourself to the next level of unconscious competence. Okay, so again, just as a brief overview, some of you are probably familiar with this already, but I want to make sure that you know kind of what to expect for this week. So tonight, we've started with our overview. We're plowing through it. And next, we're going to talk about the 4 basic building blocks of options. And the reason we talk about these is because there's really only 4 things in the world of options trading. There's only 2 types of options that exist, and you can buy and sell each of them. So that's it. There's 4 things you can do with options. That's it. If you know those 4 things and you know how they work, then you can do any option structure under the sun. And we're going to talk about a few of them. We'll talk about long calls, protected puts, and covered calls. Those of you that are in VIP, we'll also talk about some other strategies. But that's the basics, right? If you know these 4 building blocks, you can do any option strategy that exists. Some of them are complicated. You can do broken wing butterflies and iron condors and calendar spreads and all of these more complicated structures. but they're all just made of these 4 building blocks. So if you guys can master the 4 building blocks, then you can do any option structure that exists, even ones that we don't cover in the bootcamp, because there are just tons and tons and tons of possible option structures out there, right? But if you understand long calls and long puts and short calls and short puts, that's all that you need to understand any option structure that exists. Then we'll have a conversation tonight about variance. Variance is very important to talk about, especially in options trading, but really any type of trading. So this will apply not just to options, but to any trading that you do, whether you trade Forex or futures or stocks or just options, you will always experience variance. So we're going to talk about that tonight. And we'll finish off tonight talking about the options chain. The options chain is where you go to actually buy and sell options. So it makes sense that we need to kind of understand how the option chain works. Then that leads us to tomorrow. And tomorrow night, we're going to talk about option pricing. So the entire night is just going to understand how options are priced. So everywhere from the 5 different things that make up the price of an option and the variables that go along with those. So those variables are called the Greeks. These are things you've probably heard of, things like delta, gamma, vega, theta, and rho. Those are the 5 Greeks that we're going to cover. And we'll talk about what those mean, how they affect the price of your options, and essentially what you look for each of those, which will lead us into our strategies over the next couple of days. And we will end the discussion tomorrow with a topic of implied volatility. So volatility is important when you're trading stocks. It is absolutely crucial when you're trading options. If you get on the wrong side of volatility when you're trading options, then you can get a trade that moves in your favor and still loses money. And we absolutely don't want to do that. We want to get in a trade where volatility is in our favor. And hopefully we also get the direction right. That's nice as well. So volatility is critically important to understand for options trading. So we will talk about that before we ever talk about our strategies. After tomorrow's main session, there will be a VIP session starting at 9 p.m. Eastern. Again, it will go for about an hour. We'll talk about when not to trade options, because as great as options are, there are situations where it's good to stay away from certain types of options or stay away from options altogether. So it's just as important to learn what not to do as well as what to do. So we're going to talk about that in tomorrow's VIP session, as well as an open Q&A to make sure that y'all VIPs get all your questions answered. Then when we get to session 3 on Wednesday, that's when we're getting into the fun stuff. We talk about the actual buying of options, what to buy, when to buy them, why to buy options, and how to do it correctly. This will lead us to our first, did not mean to exit that. This will lead us to our first couple of strategies. The long call strategy, which is just a bet that something goes up, and a protective put, where if you're trading stocks, this is essentially buying insurance on your stock position so that if it burns down, your put will pay out and your option will essentially act as insurance, paying out when your stock burns down, for example. Then we'll finish that with we'll follow that up with our second VIP session. So those of you that are VIP will get a VIP only class after Wednesday's class again. And this one, we're going to talk about how to make money when things go down. So using options to speculate to the downside. And we'll wrap up with another VIP only Q&A. And then on Thursday, we'll have our final class on selling options. So we'll talk about what to sell, when to sell options, why to sell them, and how. So this is short selling options, meaning selling to open, not just closing the positions that we opened on Wednesday, right? So this will be selling to open, how to do that. Whoops, there we go. And this will lead us to our third and final strategy, which is the covered call strategy, which is basically renting out stocks, right? So if you own an asset like a stock, you can rent it out just like you would a rental property. So you buy some stocks, you rent it out by the month or by the week and generate some steady monthly or weekly income. Love this strategy. It's a good one. And then we'll wrap up with our final conclusions for bootcamp. Awesome. So before we begin our journey, before we get into all of that, we need to make sure that we're fully equipped. So again, starting at base camp, crossing analogies here, but I think we're all right. So first off, tonight, we're going to talk about what is an option. What are these things that we're talking about? We'll cover the 4 basic building blocks of options. We'll talk about variance, and we will then move on to the option chain before we end tonight. So first and foremost, what is an option? Let's go ahead and dive into it. I noticed we had a couple more people that were joining here, so welcome. Hope you all are doing well tonight. So options are derivatives. What does this mean? A derivative is something that derives its value from something else. The example that I always like to use is a mortgage. Okay, so a mortgage is a contract that is derived from the value of a house or some other property, right? So a mortgage is really just a loan on a property, but the value of that loan is essentially backed up by the house, right? The mortgage itself doesn't have any intrinsic value, right? It's just a piece of paper, or these days it's even electronic. So it's just a piece of paper, but the value of that contract is backed up by the real asset, which is the house. And options are kind of similar to that, right? Options are like the mortgage, where stocks are like the house, right? The stock is the actual asset. Options are a derivative of that asset. So their value is based on the underlying asset. In the example of a mortgage, the house. In our example of options, the underlying is going to be, in our case, a stock. So the option itself is just a contract, kind of like a mortgage, an agreement between a buyer and a seller. So there's someone buying the option, there's someone selling the option. Now, options are also just another category of financial instruments. So such as stocks, bonds, currency, futures, swaps, these types of things, right? Those are all just asset classes. Options are another type of asset class. What does that mean? It means that they can be traded. So just like we can buy and sell stocks, we can buy and sell futures contracts, we can buy and sell currencies through Forex. Options are something else that we can just buy and sell with each other, right? So an option contract represents each party's rights and obligations. So the option contract will say what you have the right to do and what you are obligated to do under the contract. So the buyer has rights and the seller has obligations, right? So it's an agreement between a buyer and a seller. A buyer has rights under the contract and the seller has obligations. We'll talk about what these mean later on. So the holder, meaning the buyer of the option, has the right, but not the obligation, right? They have the choice, or another word for choice is an option. They have the option to buy or sell the underlying asset, the stock, for a certain price before the option expires. So let's take a closer look at that definition. This is our textbook options definition that we're going to be using throughout this week. And we'll keep things a little bit more simple as we move into our actual strategies, but this is the textbook definition of an option that you will find if you ever look up some really dry financial books. The holder of an option contract has the right, but not the obligation, to buy or sell an asset for a certain price before the option expires, okay? And that's, we'll dive into each of these pieces, especially the ones in red there. So I want to try to break this down as simply as possible. By buying an option, you're just purchasing the right to buy or sell something, okay? So you don't have to buy or sell that something, but you can if you want to. And that's essentially how the option gets its value. Now, we're exclusively dealing with equity options here, meaning options on stocks, okay? But technically, options can be, and they are traded on pretty much any security. So you can have currency options, you can have options on futures, you can have options on indices, options on ETFs, right? Basically, any type of security that you can think of, there can be options for. We're going to focus primarily on stock options and ETF options, which are basically the same. But so the underlying security when we talk about options in this week are always going to be stocks or ETFs. Now, on the flip side of that agreement, right? So the buyer we talked about had the right to buy or sell the underlying stock. On the flip side, though, there's a seller, right? Whoever is selling that person that option. So the seller of the option is making a promise. And that's basically all it is, right? So the person who is buying the right to buy the stock, well, who are they buying it from? They're buying it from the seller. So the seller is obligated to sell that person the underlying stock. If that sounds complicated, don't worry. We're going to get into plenty of examples, especially Wednesday and Thursday when we look at the actual actual strategies and real trades and stuff like that. So we'll get into it. Don't worry. You'll be more comfortable with it as we go through, but that's kind of where we're starting off from day one. And we're going to get into the more specifics so you can see how all this works, but just bear with me right now. It's going to be very much a process of learning through immersion. So I don't necessarily expect you to get everything on day one, right? Again, you have all of the recordings as you signed up for this bootcamp. You have all of the recordings and notebooks, so you can go over this as many times as you need to, especially after bootcamp is done. Things will start to make a lot more sense, so you can go back and watch day one again with your future knowledge and things you'll, okay, I understand what he means now. So if you don't fully understand everything that I'm talking about tonight, it's okay. You don't have to. But I do encourage you to go over and rewatch things again if you need to. So in my opinion, options are like Legos. And again, we're getting into the next topic here, which is the basic building blocks of options. So, did you guys play with Legos as a kid? I did. Legos were like, whoops, let's go forward. Legos were my like toy du jour as I was a kid. Love Legos. And this presented a bit of a problem for my mother because whenever I was like building whatever I had in my mind and I wanted to build this thing with Legos, I had like this whole big bin of like all the Legos I had collected, right? And what I would do is I would take the box of Legos and I would dump them out and I would just spread them all over my floor so that I could find whatever specific piece I needed for the thing that I was building. As I'm sure you guys know, there are tons and tons and tons of different Lego pieces. I'd actually be curious to know how many different Lego bricks there are, because there's tons of unique ones that they make for all the, Harry Potter Legos and Star Wars Legos and stuff like that. So there's tons of little unique pieces. And when you have something in your mind, when you're a kid and you're trying to build something, you need like just that right exact piece, right? But this would be very frustrating for my mother, who would come home after work and, look in my bedroom and see that there were Legos from everywhere from the door all the way to the bed. Not a great time for my mother, my poor mom. But that was essentially how I would build the stuff that I had in my mind with my Legos, right? I'd dump them all out, spread them across the floor, and then I could find the specific piece that I needed because there were tons of different pieces. But as you guys know, each Lego piece individually is pretty simple, right? Like the Lego pieces themselves aren't very complicated. But by combining them together, you can build virtually anything. I'm sure you guys have seen those like gigantic Lego statues where you just build them brick by brick by brick, and eventually you have this massive statue or thing that's all made of little, very simple Lego bricks. Now, translating this back to options, options are like Legos, where the individual options themselves are not too complicated. You can combine them together to build lots of different structures. But unlike Legos, there's only two types of options. So it's like there's only two types of Lego bricks that you ever need to find, right? There's only what's called call options and put options. And these are the only two options that exist. The call option gives the holder the right to buy a stock, and a put option gives the holder the right to sell a stock. Okay, so we have different options for buying and selling the underlying stock, and that's it. Those are the only types of options that exist. It doesn't matter if you're trading stock options or futures options or currency options. There's always only going to be calls and puts. Okay, so it's like having only two types of Lego bricks instead of having to search for the perfect piece to fit whatever you need, right? There's only two that you need to worry about. And just like stocks, option contracts can either be bought to open, meaning you go long something, right? You buy it, or they can be sold to open, meaning you go short that thing. You bet on it going down in value. So if we combine buying and selling, calls and puts, that gives us the four building blocks of options. So the four basic building blocks of options is we can buy a call option, or we can sell a call option. Again, this is sell to open, not selling to close. So this is going short, right? So this is long, this is short. So we can buy a call option, or we can sell a call option. We can go long a call, we can go short a call, or we can buy a put option, go long a put, or we can sell a put option, we can go short a put. That's the only things we can do with options, okay? That's all the options that exist and all of the things we can do with them. So there's only four things that we need to learn how to do with options. Now you'll notice this is one layer of complexity more than stocks, because with stocks, we can just buy to open a stock, we can go long a stock, or we can go short a stock, and that's it, right? So that has two dimensions, whereas with options, we have four dimensions because we not only have call options, but we also have put options. So we have two different instruments that we can go long and short, which leads our four building blocks of options. So if we know what buying a call option means, or what selling a put option means, we know what selling a call option means, or what buying a put option means. If we know all four of those things, then we know everything that we can do with options. Just like with Legos, the complexity of options trading comes from how those four building blocks are combined into different structures. Bill coming in with the stats, 3,764 unique Lego elements available. That's incredible. Can you imagine having to keep track of 3,500 different types of pieces? Crazy. But with options, we only have to remember two of them, or really four, with the buying and the selling, right? So we have two different types of bricks and two different ways that we can structure each brick. So a total of 4 different ways that we can combine things. Now, in my experience, over the years, I have found that complex option structures aren't necessarily better. I can't say I've traded every option structure under the sun because some of them are dumb and I don't need to trade all of them. Some of them have stupid high margin requirements and aren't worth doing and are super risky. So I haven't traded every type of option structure, but I have traded most of them. And I can tell you from experience that they're not all equally useful. And the ones that are more complicated aren't necessarily better. In fact, I have found that in most situations, the most useful option trades tend to be the simplest. So throughout this bootcamp, we're going to be keeping things super simple, right? Principle of KISS, keep it super simple. That's what we're doing. The most important thing that I want you to master throughout this week is the 4 building blocks, okay? I want you to focus on buying call options, selling call options, buying put options, selling put options. If we know those, then we can do any option structure that exists. So if you know those 4 things, you'll be equipped to handle any option structure out there. It's also important to note, before we get any further, I want you guys to understand that options do not tell you anything about what the stock is going to do. We can explain this a little further tomorrow when we get into pricing and we talk about delta. At the money options always have a delta of 50, and delta can be kind of a proxy for how likely a stock is to get to a certain price. So an option that has a strike price of the same price that the stock is trading at has a delta of 50, which means there's basically a 50% chance that the stock goes up or down from there. And all options have that. Tell you the single coin flip chance of the stock going up or down from any given price at any given time. Now, we can use our fancy technical analysis and look at trends and supports and resistance and all of that stuff, and that's good, and you absolutely should. That kind of gives us more of a meta view of what is likely to happen with a stock. However, no stock has to go up or has to go down. And options don't tell you if a stock is bullish or bearish. They don't tell you if a stock is going to go up. They don't tell you if a stock is going to go down. Okay, we do not use options for our stock analysis. We do the analysis first using all the things you already know: support, resistance, trend lines, indicators. Okay, you do that first to find your stocks. Once you have a stock you want to trade, options are just a way to express your view. Okay, options are just a replacement for buying or selling the stock. Okay, rather than buying or selling the shares, you can buy or sell options. But the options do not replace your stock analysis. You don't trade a stock just because of the options. Does that make sense? That would be putting the cart before the horse. You do your analysis on the stock. Once you think, okay, I'm bullish on the stock, well then, instead of buying the stock, you could buy a call option, or you could sell a put spread or something like that, okay? So that's essentially where options fit into the puzzle here. They're a way to express your view on a stock. They do not tell you which way a stock is likely to go. So don't confuse options for stock analysis. That's not their role. They let you structure a trade with far more flexibility than stocks do. Rather than just buying or shorting the stock, options give you many more ways to take advantage of a stock. In fact, I just want to show you guys this real quick. You're in boot camp, so you can deal with something a little more complicated here. So I have this trade on snow. And on this trade on snow, I had what's called a calendar spread here at 140, which basically would make money as long as the stock stayed between, I think it was like 145 and 130-ish. Well, or maybe it was 135-ish. It was this band that I was betting on the stock staying between. And today, really the last couple of days, snow has come down quite a bit, and it got uncomfortably close to where I would start losing money to the downside if it kept going down. And in fact, I'm close to my ADX being above 20 with some negative bent here, which basically means that I'm close to the stock trending bearish. So what I wanted to do was give myself more room on this trade. Now, you don't have to understand the mechanics here. This is pretty complicated. This is a more advanced options trade. I'm going to show you this. It's going to look weird, might blow your mind. This is what the trade looks like. It looks weird. It looks freaky. Kind of just strange, right? What I want to do is I want to show you what it did look like, okay? So this is what the trade did look like before. Notice that as the stock would get here around 130, I would start losing money, right? As I go below zero here, this is where I start losing money. So if the stock was at 130 or below, again, this is the stock price here across the x-axis, I would start losing money here. Okay, well, I didn't like that. The stock was getting uncomfortably close to 130. Now, it did rebound a little bit during the day, so that was nice, but the low today was what, 131.62? That was uncomfortably close to 130 here, where I would start losing money. So I adjusted this trade by moving half of it down to 130. And now I have this structure that can make money anywhere between 126 and 146. And that's these lines here. Okay, so instead of losing money if the stock gets down here to 130, now I can make money if the stock gets down here to 126. So what I've done is I've taken an options trade, and for this adjustment, I've only paid $15, which is also freaking awesome. But the important thing is, for 15 bucks, I've given myself another like $5 here that I can make money on this trade. Well, $4. Another $4 range here that I can make money on this trade, right? I just need the trade to be somewhere between 126 and 146, 126 and 146. Anywhere in this $20 range, I can make money on this stock. And that's just by Friday. And my probability range here, if we go ahead and set my slices to break even, I have a 72% chance that the stock is between those two levels, okay? So super powerful stuff, right? What I want to show you here is that this is something that I could not do with stock trading. We're not going to talk about calendar spreads and adjustments and all of that stuff in boot camp, because that, again, this is a little more complicated, a little more advanced. But I just want to show you the big picture. If I had just bought the stock here at 140, I'd be losing money, and there isn't really anything I can do. I mean, I can average down, I can buy more when it gets down here to 131, but then I'm just taking more risk, right? With this trade, I'm actually not taking any more risk. I had two contracts up here at 140. Now I have one contract at 140 and one at 130. I haven't taken any more risk on this trade, but I have a wider range that I can make money now. And I've adjusted the trade in a way that gives myself more chance to make money, even if the stock keeps moving. So again, just big picture stuff. If I bought a stock, I would just be losing money, and there isn't really anything I can do about it. Sure, I could average down, but I'm still down on the trade. Whereas here, I'm actually up on the trade. I've made about 70 bucks already on this trade, and by Friday, assuming I'm somewhere between 126 and 146, I will have made some other amount of money, up to around 300-ish. Okay, so the point here is that I expanded the range in which I can make money on this trade. It only cost me 15 bucks to do that total. And now I have a bigger range in which I can make money. And this is something that I could not do if I bought stocks. How freaking cool is that? So options are just so much more flexible. So rather than just buying or shorting the stock, options give me way more ways to take advantage of a stock, whether it moves or not. This trade actually makes more money if the stock doesn't move, right? If it just kind of chops sideways, that's the perfect thing for that trade that I was looking at. I'm actually betting on it not moving a lot. But it's important to remember that options are just that. They're a way to structure trades. They don't forecast stock movements. So that's the big picture there. Okay, let's talk about variance. So variance is a concept that kind of comes from the poker world. I mean, it doesn't necessarily come from there, but it's very applicable to that. For those of you that have played poker, this will sound very familiar. If you're not a poker player or a gambler, maybe this won't be as familiar to you, but variance is just as applicable to poker trading or poker playing as it is to trading. So we're going to talk about them. We're going to talk about them very similarly because they are very applicable. The concepts apply just as much to one as to the other. And it's not necessarily to say that trading is gambling, although it has a lot of overlap with gambling. But of course, we have things like technical analysis. Essentially, what we're betting on is we bet on things that are higher probability than others. And good poker players do the same thing, right? While there is randomness to any given hand that you might be dealt in poker and any given river, right? Any community cards that could be played, we don't know what cards are going to come up. We don't know what cards we have in our hand, and we don't know what cards we're going to be dealt in our hand, and we don't know what everyone else has been dealt, right? But there are still ways to play probabilities in poker. And that's why the best poker players are the people that continually show up to Pro Tour over and over and over again, right? You have very similar names that show up year after year after year. If it was just dumb luck, of course, you wouldn't see the same people consistently winning at poker. So there is skill to it and there is probability. And the people that are best at playing the probabilities and betting on high probability hands are the ones that tend to perform the best in poker. And it's the same thing with trading, right? The more high probability trades you take, the better chance you have of making money trading. Whereas if you tend to bet a lot on low probability trades, well, the chance of you making money trading is very, very low. So we have our fancy technical analysis and fundamental analysis and all the ways that we can analyze a stock chart to give us the best chance of making money, right? That puts probability in our favor. But just like any given poker hand or any given trade, there's no guarantee that the market's going to go up or our individual stock is going to go up or down over any given time horizon. We can play the probabilities, and that's what we have to do, but there's no guarantees, right? So that leads us to the concept of variance. And variance is a concept that just refers to the volatility of returns. So not the returns themselves, but how much those returns change, okay? The volatility of the returns. It's, in layman's terms, the upswings and downswings of your trading results, okay? Basically, the idea is that no one wins every trade. You guys should know that by now. That shouldn't be a surprise to you. I don't win every trade. You don't win every trade. Josh loves to talk about the months where he has 100% win rates. That's kind of his thing. He loves to have very high win rates. So Josh focuses on very high win rates. I focus on very high returns because I don't really care if I have a 50% win rate as long as my winners are much higher than my losers, right? Josh likes really high win rates, so that's kind of his thing. But even Josh doesn't win every single trade. So you will have periods where you win and you will have periods where you lose. It's important to understand this from the outset, even more so for options trading. Of course, this applies to stock trading as well. I'm assuming everyone here has traded stocks already, that none of you are brand new to stock trading, but if you are, this is important to understand. Now, especially when you're new to options, or if you've traded options before, maybe you're new to trading options correctly. One, you're going to make mistakes, okay? You're going to lose money. You're going to feel frustrated and overwhelmed at times. This is completely normal. It's normal to feel those things. It's normal to experience losing money when you're trading, okay? And that's one reason why it is super important to start with a paper trading account. I want you guys to practice the things that we're learning in bootcamp this week. When I teach you the long call strategy, or I teach you the covered call strategy or something like that, or protective puts, I want you guys to go practice those trades, but don't do them with real money, okay? Practice them with a paper trading account because you're going to make mistakes, you're going to lose money, whatever the case may be. I want you to make those mistakes in a risk-free environment where real money is not at stake. I want you to get used to trading options and get comfortable with it in a paper trading account before you ever think about risking your real hard-earned money, okay? So hopefully we can all agree to that. Once you've proved that you can make money consistently in a paper money account, then and only then can you consider moving to a real money account. Now note that consistently does not mean always. It doesn't mean you win all of your trades. You will still have losing trades, okay? We all do. But if you can achieve even just a 50% win rate, if your winners pay 2 to 3 times what your losers lose, then you are well on your way to being a great options trader. Difficult to achieve with stocks, not as difficult to achieve with options. So here's just a made-up example, right? With very simple numbers just to show you how this works. So let's say that you risk $100 per trade. Let's say that our imaginary account here is a $10,000 account, okay? And over a 10 trading period, we have 5 wins and 5 losses. Well, that means our win rate is 50%, right? Which is not necessarily anything to write home about, but it's not terrible either. Some of the best traders in history have had win rates less than 50%, right? The important thing is not that you win all your trades, it's that your winners make a lot of money and that your winners are capped, right? That you don't lose a lot of money on your losers. So if we kind of go through an example of 10 trades here, and this is just assuming that every trade you take, every trade that you lose, you take a max loss on that trade, which in reality, we wouldn't always do, right? We can stop ourselves out early. We can adjust our trades to turn losers into winners, blah, blah, blah. But this is just a hypothetical where every trade that we lose, we take a max loss on. And our winners, we win more than our losers, right? This is kind of the most important things to have. So let's say trade number one, we start off with a loss, we lose $100. Then our next win, we win $200 because we're trading options, right? Our next, let's say we have two losers in a row, we lose $100 on each, and then we win 150 on our next one. Then we have, again, 100% loser, we lose $100. Our next two winners, let's say we have a couple big ones, we make $200 and then $300. We have another loser, and then we end up with another winner, right? So half of these are wins, half of these are losses. But my winners are anywhere from 1.5 to 3 times how much my losers lose, even when I'm taking a max loss every single time on my losers. That still ends up making $550 over a 10 trade period, which is growing the account by 5.5%, right, on a $10,000 account. So that's great. I mean, this is a fantastic trading result. If you can get this consistently, this is what you need to grow an account over time. So the point here is that it's not necessary to have a high win rate as long as your winners win more than your losers lose. Now, with stock trading, this can be difficult to achieve because you need the stock to move 2 or 3 times as much with your stocks when they work as they don't when they lose, if that makes sense, right? Your winners need to move more with your stock trading. With options, that's not necessarily the case. So it's much easier to achieve this type of result with options than it is with stocks. It's because options have that built-in stop loss to the downside where you can't lose more than you paid for the option, right? You have that built-in stop loss and you have built-in leverage to the upside. So when you're right, you make a lot more. And when you're wrong, you have that cap built in. So together, that means our losers have a strict cutoff, while our winners have a lot higher potential for those larger returns. What this does is it provides what's called risk-reward asymmetry. And this asymmetry is a core concept of trading options. When we're trading options, we are always looking to maximize our risk-reward asymmetry. Essentially, we're always seeking smaller risk and larger reward, right? We want to tip those scales as much as possible. Okay, so back to the concept of variance and how this ties in. Variance is the difference between the short-term results that you're experiencing in the here and now versus what your system expects over the long term, right? Now, this cuts both ways. Positive variance is when your trades are more successful than average, right? You're on a hot streak. Negative variance is when you are losing more than average, right? You go on a cold streak. Everyone experiences both of these things, and it's important to understand this from the outset. Both positive and negative variance are both normal parts of trading. So this means that even if you follow your trading plan to a T, right, you follow your plan perfectly, you can still lose money on any individual trade. This is to be expected. No, not every trade ends up being a winner, no matter how promising the setup is. We cannot control what the market or what any individual stock does. What we can control is how we position ourselves, right? So we can take trade structures that have a higher probability of making money and stay away from trades that have a lower probability of making money. We can position ourselves to have a high probability of making money. That doesn't mean that every high probability trade is going to make money, but it means that we put ourselves in the best position to make money. And that's why I love trading options. That's why most other people that get into options trading don't go back to stock trading. You have this superior risk to reward asymmetry compared to trading stocks. Now, the reason I bring this up is because it's super important to understand this in the beginning. Otherwise, you might get frustrated and abandon the whole concept of options trading or just trading in general before giving yourself time to work out the variance. You're always going to have variance in trading, but it's always going to be highest at the beginning because you have the least experience, right? When you're learning to trade something new, like options, you're going to have tons of variance. When you win, it's going to feel amazing, but it might be harder to get those at the beginning because you don't know what you're doing, right? And I'm here to help guide you through that, but this is normal. It's normal to have high variance when you're starting out. So the Hitchhiker's Guide to the Galaxy says on big friendly letters in the front, don't panic, right? Everything's going to be all right. Always keep in mind that no single outcome determines the validity of a process. Now, here's what I mean by those $10 words. It's a common fallacy to think that something was a bad idea just because it didn't work out. And that's not true, right? Or the flip side of that something was a good idea just because it did work out, right? That's not the case. You can take a terrible trade and it can happen to work out for you. That doesn't mean you should have taken the trade, right? Just because something worked out doesn't mean it was a good idea. And vice versa. You could have taken a trade with a high probability of working out and it just didn't work out that time. What's more important is whether the decision-making process was valid, right? So let's say, for example, that you take a trade with an 85% chance of making money. You can easily structure these with options. You can do these week in and week out. You can find a trade that has an 85% probability of paying off. Let's say, though, that the trade doesn't work out, right? We land in that 15% of the time where it doesn't work out. You end up losing money on that trade. Does that mean that you should not have taken the trade? Of course not, right? Even with an 85% chance of making money, there's still a 15% chance that you lose on that trade. So it doesn't matter if you take that trade once and it doesn't work out. That's just an example of high variance. What matters is that you take that trade 100 times and you win the vast majority of them, right? You should expect to win 85% of the time when you take that trade. And that's essentially how you smooth out the effects of variance over time. So moving on a little bit. What causes variance? Well, there's an inevitable amount of luck in trading, right? Whatever you want to call it. We can identify patterns, and that's really what technical analysis is it's pattern recognition and identification. But at the end of the day, no stock has to go up or has to go down, right? It doesn't matter how much analysis you've done or how likely it is that the stock goes up or goes down or reverses from here. The stock doesn't have to do anything, right? You can find an unlimited number of situations where everything was bullish and then some news came out and the stock dumped or the market dumped and dragged the stock with it, right? Happens all the time. Or we're in a bear market and everything's going down, but then suddenly there's a bear market rally, right? And things shoot up steeply, sharply, despite the fact that we're in a bear market and things in general are going down, right? Happens all the time. And this is why at-the-money options have a 50 delta, which we'll talk about tomorrow. But basically, at any given point in time, it's a coin flip whether the stock is going to go up or down. If that was not the case, market makers would not price at-the-money options with a 50 delta, but they do. So that's important to understand, right? No matter how much analysis we do, nothing makes the stock go up or down. Even though we can say from our meta-analysis through, technical analysis and all that sort of things, sure, we might have a higher probability of bouncing up from support or down from resistance and blah, blah, blah. Those are all true, but nothing forces the stock to go up or down. It's important to understand that. But it doesn't mean that all trading is just luck and everything is a 50-50 coin flip and, everything that we do should just be based on luck. That's, of course, not the case either. There are people who are better at trading than others, right? It's a skill that can be learned. There's a large amount of skill in trading, just like playing poker, right? Sure, you can just guess and, try to get lucky with all of your hands, but it's much better if you play probabilities in poker because every hand has a certain probability of winning. And if you only play higher probability hands, you have a much better chance of winning at poker than if you just play all your hands and hope they work out. So same with trading. If we only take higher probability structures, then we have a much better chance of making money with trading. Okay, so there's a large amount of skill that goes into it as well. The better you are at analyzing stocks, right? So getting a higher probability of the stock doing one thing than another, and also better at creating favorable structures, such as trading things with options rather than just buying the stock and hoping it goes up, the better chance you have of making money on a trade. Another thing that causes variance is your trading style. So the more risky your trading style is, and I'm a fairly aggressive trader, so trust me, I know about this, it adds a lot more variance that you should expect to experience. And that doesn't mean that aggressive trading is bad. It just means that you should expect to have a lot of variance in your trades going in. And that's fine, as long as you are aware of that going into it. Some of you might be, for example, trading retirement accounts. Well, in that case, you probably don't want very high variance, right? You want to keep things a lot safer. You don't want to be taking risky trades. You want to be very conservative with your trading. And so you should expect smaller variance in your trading. And if you end up having a lot of variance in your trading, well, it's probably time to reevaluate what you're doing and see if there's some changes you could make to get things lower variance. Additionally, this is just kind of an add-on here. The more time you tend to give your trades to work out, the less variance you tend to experience. So if you are exclusively a day trader, it is very difficult to make money day trading the way that most people try to do it. Now that we have zero DTE options, there are higher probability ways to day trade, in my opinion. Now is a great time to be day trading. But generally speaking, if you go from day trading exclusively, like intraday trading, and then you just start holding your trades overnight, you will tend to give yourself more time for those trades to work out, which tends to lead to lower variance. So we try to get people to expand their time horizon. And that's not saying if you're a swing trader now, you should become a long-term investor or anything like that. But generally speaking, stocks tend to go up over time, maybe not necessarily the environment that we're in right now, but as you know, over longer and longer and longer timeframes, on average, generally, stocks tend to go up. And there's reasons for that that may not continue in the future, but that's a completely different discussion. But in general, stocks tend to go up. So the longer you give yourself time for a trade to work out, the more likely you are to make money on that trade, which leads to lower variance in your returns. Your trade structure is also something that will cause variance. So some trade structures inherently lend themselves to more variance than others. So to give you two examples here, these are both option structures, but there's something called a synthetic long, which basically uses options to mimic a stock trade. So a synthetic long structure has exactly the same risk reward that buying the stock would have, which means it's a very high variance, right? If the stock goes up, you make money. If it goes down, you lose money, just like buying a stock. That's very different to a trade like, for example, a diagonal spread, which is a more advanced trading structure. We're not going to talk about those in the boot camp, but a diagonal spread can make money no matter what way the stock goes. It's more advanced, but there are option structures that can make money whether the stock goes up or down, and a diagonal spread can do that. Or something like an iron condor. If you stay within a range for a stock, then you can make money whether it goes up or down within a certain range, right? Or if it just trades sideways. So those have lower variance because they have very high probability of making money. You would need a very extreme move in the stock in order to lose money on that trade, which, you know, has a much lower probability of happening. So with a very high probability trade structure, no matter what the stock is doing, you can have a high probability of making money, which means most of your trades are going to win, which leads to very low variance, right? Okay, so how do you minimize variance then? So those are things that contribute to high variance or contribute to variance in general. So how do you minimize it? The first and most important thing to do is just practice, right? Trade. Do it. Do it in a paper account if you need to. But again, you can't make the market or stock do anything, but what you can do is take control of the trade structure that you use and your analysis on a trade. So if you analyze a stock and there isn't some weird news that comes out, but the stock goes the opposite direction of what you thought, is there something you missed in your analysis? Go back and see, was there some indicator that would have helped me at least pump the brakes? If not trade it the opposite direction, at least tell me, oh, maybe I shouldn't have bought this stock because of X, Y, and Z, right? Maybe it was getting overbought. Maybe, you know, my RSI was getting overextended, or I didn't see that I was at a strong weekly resistance level or something like that, right? Was there something that I missed in my analysis? When things go right, of course, it's easier to analyze because you basically just go, oh, yeah, okay, I saw the signs were right, it worked out, and everything was great. Okay, cool. Maybe not too much analysis you can do there, but essentially, especially when things go wrong, you want to go back and reanalyze what happened. Was there something that you missed? Same thing with trade structures. Now that you guys are going to learn some better trade structures than just buying stocks, was there a better way that you could have structured this to give yourself a better chance of making money? All right, the next thing that you can do to minimize variance is take better, trade structures, safer trade structures. So if you're a more risky trader like I am, instead of buying like out of the money call options, you could buy closer to the money, buy at the money or in the money. Those things will reduce your variance because they have a higher chance of making money. Same thing, you can use trade structures that skew risk-reward asymmetry in your favor, such as spreads. I love trading spreads. We're not really going to get into spreads much in the boot camp here, but if you guys finish boot camp here and you want to move on to a little bit more advanced stuff, I highly recommend you look up vertical spreads. They're one of my favorite things to trade. They give you better risk-reward asymmetry. They just kind of build on what we learned. And we can talk about them a little bit in class if you would like to. Especially y'all VIPs will have time for that. But yeah, they basically just give you a greater chance of making money on your trades because they have better trade structures. The next thing that you can do is just risk less per trade. Now, I don't personally use stop losses on most of my options trade. I do sometimes. There are situations when I do that. But, and of course, you're certainly welcome to if you want. But at a bare minimum, you should make sure that no single trade risks more than 5% of your portfolio at a time. And you can cut that down to less than that if you prefer. But first thing I would do is if you are risking 10, 20% of your portfolio on a single trade, I would say cut that out and drop it to 5% of your portfolio at a bare minimum, or a maximum, I should say. And a lot of people won't take trades that are more than 1 or 2% the size of their trade. And I think that's perfectly reasonable. Okay, so that's all about variance, how it comes about, what causes it. It's totally normal, and some suggestions for reducing it. But the most important thing is just practice. Like, practice what you're going to learn this week. Practice taking those trades, get better at it, right? And those of you that are, trading stocks, like, practice your analysis, your technical analysis. If you do fundamentals, whatever, the more you do it, the better you'll get at it. So just keep practicing, and you'll get better, which will reduce your variance. Okay. The last thing we're going to talk about tonight is the options chain. So the options chain is where you actually go to buy and sell options. So it might look intimidating at first, but basically it's just a big long list of all the option contracts that are available for a given stock with information about those contracts. So it's easiest to explain by example. So we're just going to jump over to Thinkorswim. I'm going to look at what the next slide is. Okay, great. So over to Thinkorswim. This is what an option chain looks like. Let's go ahead and just look at these. So this might look scary and confusing and all of that. Tons of numbers, tons of stuff going on here. And I'm actually just going to close these. So we just look at the option chain here. In fact, it's probably better just go to the trade tab. Okay, so this is an option chain. Again, I don't want to alarm you with all of this. It might look really scary, but it's not. So here's how an option chain is laid out. And this is a very basic option chain. We've got columns, essentially, here. And we've got rows, right? As I mouse over this, you can see the rows getting highlighted here. Or if I click one, you can see it get highlighted in blue. So we've got rows on the left and we've got rows on the right. Okay. On the left, and basically every option chain is laid out identically. So it doesn't matter if you're not using Thinkorswim. If you go to TradeStation, your option chain is going to be laid out almost identically. The difference I have found is that in Thinkorswim, they put the expiration date here in the middle, which most other platforms don't do. This is weird. Usually you'll just have the strike in the middle. So this is unique to Thinkorswim for the most part. But we also have the date here across the top, which is the most common. Okay, so first things first, let's talk about that date before we get into all of these columns and rows and all of that. If I collapse that, the first thing you'll see that come up here is that when I open my options chain, I just have a bunch of dates here. What does this mean? Well, these are the expiration dates for the options. So as you might know, options don't last forever like stocks do. Options expire, which means if we are going to buy or sell an option, we are expecting to be right before that option expires. So on snow, for example, the trades that I have here are a little complicated, but I'm basically betting that the stock stays between whatever my numbers were here, 126 and 146 by Friday. And that's because I have these options here that expire on Friday. Okay, so I have some options that expire on Friday. I have some that expire in April. Again, this is a more complicated trade structure. I don't want you to focus on that. What I want you to focus on is just that options have an expiration date, okay? So they don't last forever. And the options chain here will show you the actual dates that they expire. And then in parentheses, it usually says how many days until that happens, right? So the March 24th expirations, well, that's 4 days away. And then these go every week here. And you'll notice that it says here in gold, weeklies. So these are options that expire every week. So 4 days until Friday, and then another 7 days after that, another 6 days after that. Why is April 6th? The market's probably closed April 7th for, that's Holy Week, isn't it? So 6 days after that, because I believe the market closes on Thursday that week, and then 8 days after that, because Thursday to the next Friday, right? But generally speaking, options expire on Fridays, right? So every Friday, you have a weekly expiration. Now, not every stock has weekly expirations. If you get to lower liquidity stocks, you'll find that you just have these gray ones here, and these are monthly expirations. So monthly expiration for options is the third Friday of every month. So we get April 21st is our monthly expiration in April. May 19th is our monthly expiration in May, and then June 16th, July 21st, blah, blah, blah. For stocks that have weekly options, you'll find those here in gold, but you'll notice that we don't have weeklies far out into the future. Weeklies are usually only like 5 or 6 weeks out into the future. Now, some stocks that are super liquid, and actually, as far as I know, this is only true for ETFs. For example, if we go to SPY, SPY actually has options that expire more frequently than weekly. So SPY, the Qs, and their respective indices, so SPX and NDX, these actually have options that expire every single day. So 1, 2, 3, 4 days, right? So I have options that expire every single day of the week for SPY. Whereas with most stocks, so even if I go to a huge stock like Apple, notice we just have Fridays. So March 24th, 31st, 6th, 14th, 21st, 28th, right? Or even a huge stock like Tesla. Despite the mass amount of volumes on these stocks, they still only have Friday expirations for weekly options. So maybe one day, eventually we'll get to daily expirations for individual stocks, but we're not there yet. Okay, so to back up for just a second, not all stocks have options, okay? Very, very illiquid stocks, stocks that are very low market cap, if you're trading like penny stocks or OTC stocks, God forbid, if you're trading garbage like that, you probably won't have any options. Or if they're brand new, they might not have options yet if they like just got listed, but that's not always the case. However, stocks that are more liquid, that are higher market cap, will nearly always have options on them. And stocks that are more liquid and usually higher market cap will even have weekly options. So there's tons of stocks that have weekly options. For example, I can just come in here, remove all my criteria, and just look for all stocks that have weekly options here. And there's 522 of them. So that's plenty of stocks to choose from, okay? So, and that doesn't even include ETFs. If I did all stocks and ETFs, we just did all optionable, 624, right? So we get even more than that. So there's plenty of stocks to choose from that have weekly options. Don't get me wrong. It's not like it's a small list. Most stocks that you'll be trading will have weekly options. Okay, so you choose the expiration that you want. We'll talk about how to choose which expiration once we get into buying and selling options. But for now, just bear with me. Let's just choose the April monthly expirations. Monthly expirations tend to have more liquidity than the weeklies. So even when the stocks have weekly expirations, there are less people buying and selling the weekly contracts than there are the monthly contracts. The monthly contracts still have more volume, more people trading them, so they have higher liquidity. It's easier to get in and out of these trades. So we're just going to take a look at these monthly expirations. Sean, I'll answer your question at the end of class. And we're going over time, as always, a little bit. So bear with me here. Let's go ahead and talk about the option chain. So as I choose the April monthly expiration here, as we expand this, now we've got our row and column view here. So what's important to know here, let's go ahead and pick the 190 strike option for Tesla here on April 21st, okay? What's important to note here is that each row is one option contract, okay? So this row here at 190 is different than this one here at 185. So this row is a 185 strike call option. This row here is a 190 strike call option on Tesla. Okay, so these are different options. Each row here represents an option contract. The columns just tell you things about those contracts. So looking at this 190 strike contract, well, I have always my bid-ask column here, okay? So the bid-ask spread for this 190 strike call option is $11 by $11.10, okay? So just like with stocks, right, on Tesla here, I have the bid-ask for Tesla. It's trading at 183.31 by 183.33, right? So it's got a 2-cent bid-ask spread, which is nice and tight for a stock. For options, we have a 10-cent wide bid-ask spread, which is also very tight for an option. So these are very liquid. There's tons of people trading these, and market makers price these very close together. So $11 by $11.10, that's a nice tight bid-ask spread for an option. Cool. So if we wanted to buy this stock, we could buy it for $11.10. If we wanted to sell it, we could sell it for $11, or we could try to split the difference at $11.05. Okay. Just like with stocks, the bid-ask spread behaves exactly the same. Then we've got our last price here and the net change. So the last price this was traded at was 11.05, right in the mid price there. And these contracts in general have gone up 75 cents today. So from Friday, or last time the market was open, they were 75 cents less, and today they're 75 cents. So Tesla went up today. Tesla went up 1.73% today. And so you can see how the options have changed. Hey, David, no problem. Glad to have you. We're just wrapping up here, and we're just talking about the options chain tonight. So we're almost done, but you caught us right at the end here. So with my options chain, I don't have to look at these two columns. Now, I'll always have my bid-ask columns here, but I can actually customize this to anything that I want to see. So if I come up here to layout, this lets me choose what I want to see. So I could look at a theoretical price, which lets me adjust it lets me put in a stock price and then tell me what the options would theoretically be trading at on that day and with that stock price. I can also look at things like volume and open interest. So this tells me the liquidity of the stocks. So the volume is the same just like it is on stocks, okay? The Tesla volume for today was 129.684359 million shares traded, right? So we had 130 million shares traded on Tesla today. The volume here, it's telling me that there were 4,117 of these 190 strike call options traded on Tesla today. The next column here is open interest. So open interest is something you have with stocks that you don't have, or that you have with options that you don't have with stocks. So open interest tells me the number of contracts that existed at the beginning of the trading day. So this only updates once per day, and it updates before the market opens. Options only trade when the market is open. So there's no pre-market and post-market trading with options. They only trade during the cash session. So at the beginning of the day today, there were 5,681 contracts that existed that people had bought or sold at the time. So there were 5,681 contracts open at the beginning of the day, and 4,117 contracts traded hands throughout the day. That could be new positions that added to this. That could be closing positions that reduced this number. And it could be contracts that were just traded back and forth amongst other people. So there were 4,000 contracts traded. At the beginning of the day, there were 5,500 that were open. And basically, the higher these numbers, the more liquidity. Okay. I actually don't think these zeros are accurate. I would be very surprised if there were 0 contracts traded on these, but I suppose it's possible. The numbers kind of get weird on Tesla here. Let's go back to Snow. Or we could look at Apple, I guess. So these numbers are, well, that's kind of weird. Okay. The numbers kind of get weird when you're after markets, but when the market is open, these numbers will look a lot more normal. The fact that there's zeros in here are not right. I guarantee you there's not 0 contracts existing here when there's 56,000 on either side of it. Yeah, but even with the $0.50 increments here, or the $2.50 increments, like there should still be people trading these, right? Like there was 1,500 contracts traded today and there's 0 outstanding. Like that's not true. This is just Thinkorswim not updating properly when the market's closed. So you can ignore those zeros. But basically, we have very high volume, very high open interest, lots of liquidity here. Okay, so that's one of the things we can look at. We can also look at our Greeks. So I like to look at delta, gamma, theta, and vega. In fact, I often don't look at vega. My personal layout, if you want to, you can come down here to the customize button and then choose whatever you want. So pick whatever you want here. I like to see, for example, volume. So just click what you want to see and then add items. And then I like to see open interest. Those are our 2 liquidity items. So open interest, add items. Once you have these here, you just hit OK, and it changes your columns. Okay, so now I've got my delta, gamma, theta, and vega, as well as my liquidity indicators and my bid-ask spread. Now we're going to talk about delta, gamma, theta, vega, and another one called rho. We're going to talk about those tomorrow. So those have to do with option pricing. You don't have to know what these mean right now. Don't worry about it. We'll get to it. But all I want to explain here, all I want to show you is that these, like each one here is just an option, and the columns just tell you things about that option. So one thing I didn't do is kind of back up a little bit and do a little bit more big picture. So we have calls over here on the left and we have puts here on the right. So remember, a call option is just a bet that the stock goes up, and a put option is a bet that the stock goes down, to keep things very simple, right? Call option gives you the right to buy Apple. A put option gives you the right to sell Apple, shares of Apple, right? The stock. So that leads us to the strike price. What is our strike price here down the middle? Well, the strike price is the price at which the contract gives you the right to buy Apple. So that might sound a little confusing. Let's look at an example here. Let's look at the 160 strike call option on Apple here. Okay. So the 160 strike call option, Apple's currently trading at 157.40. So it's not trading at 160. So what does this 160 contract mean? The 160 contract means that I have the right to buy Apple for $160 per share. Now, Apple's currently trading at 157.40. So why would I want to buy Apple at 160 if Apple's trading at 157, right? I could just buy it in the market right now for cheaper than it's trading. Well, the reason is if I think Apple's going to go up. If I think Apple would go up above 160, then it would make sense to buy these. If I think Apple's going to go up to 165, well, this contract gives me the right to buy Apple at 160. Okay. So I can buy this right to buy Apple at 160 for about $4. Okay. So let's say I pay $4 for the right to buy at 160. If Apple went to 165, I have the right to buy at 160, which leaves me with $5 of built-in equity. And I only paid $4 for that right, which means I would have an immediate built-in profit of $1. So that's kind of the point of buying these, is it costs me less than my expected move in Apple, so I can make money on this. So the strike price is just the price of the contract. Remember, if we go back to our textbook definition, all the way back up here, the holder of an option contract has the right, but not the obligation, to buy or sell an asset. In this case, we're looking at Apple. So Apple's our asset. For a certain price, this is our strike. Okay. So in this case, on Apple, we're looking at the right to buy it at 160. Before the option expires, which we know is on April, I think 21st was the option that we were looking at. So by April 21st, which I think it said was like 32 or 36 days away from now, basically a month from now, as long as Apple, well, I have the right to buy Apple at $160 per share, for $160 per share, anytime before April 21st, okay? Now, I would only want to do that if Apple is trading above 160, right? That's the only time it would make sense to do that. I could also buy in the money. So Apple's trading at 157. I could actually buy Apple at $150 per share. Well, that sounds amazing. I can buy Apple for less than it's trading. Why wouldn't everyone just do that? Well, the reason is because, look, it cost me $10 to do that, right? So if it cost me $10.50 to buy Apple for 150, then that means my total price per share is still over 160, right? I pay $10 to buy it at 150. That means my total price per share is still about 160, and Apple's only trading at 157. So if I was trying to do that, it would make more sense to buy just the individual shares. But again, there's reasons to buy these option contracts, especially when you don't want to buy the underlying stock. But we'll get into that. But basically, the point here is that we have call options on the left, we have put options on the right, and then our strike prices down the middle are the contract price at which we have the right to buy or sell the underlying asset, right? I keep going to that instead of Keynote. So the certain price here, this is our strike price. Okay, this is the price at which we have the right to buy or sell the stock. I gotta stop doing that. Does that make sense? Sorry, I know strike price is kind of a confusing topic for people when they're first learning options, but it's the price at which you have the right to buy or sell the underlying asset. So for calls, if I bought the 160 strike call option, I have the right to buy Apple at 160, no matter what Apple is trading at. So if Apple were to go back here up to its recent highs up here around 175, I would still have the right to buy it down here at 160. And that right would be worth at least $15 per share because Apple is trading $15 above that, right? So that would mean that this contract would be then $15 in the money is what we call that. And we'll talk about that terminology tomorrow. In the money, out of the money, at the money. Basically just means how much intrinsic value is in that option from where the stock is trading now to where you have the right to buy or sell that option. If we look at the put side here, I could do the opposite, right? So if I bought the 160 strike put option, that gives me the right to sell Apple for $160, no matter what it's trading at. So if I owned 100 shares of Apple here at $157.43, and Apple went down, right? If Apple just kind of, we're kind of sitting at resistance here, maybe it tops out here, goes back down to 145. Well, if I bought the 160 strike put, I now have the right to sell my shares that are only worth 145 now. I have the right to sell them for $160 per share. That's pretty cool, right? So a put option helps protect you if the stock goes down because you have the right to sell for a higher price than it's trading at in the market. So that's how the strike price works on a put option. Does that make sense? Again, I know it's a little confusing when you're first learning options, but give me a yay or a nay if that's at least making a little sense. And again, if you need to go back over this, perfectly fine. You have the recordings. Okay, looks like it's making sense for most people. So that's just the options chain. That's where we go to buy and sell. Dang it. So if I want to buy, I can just click anywhere here in the ask column, right? So if I want to buy my 160 strike call, I can notice when I hover over this, you get that tiny little label that comes up and says buy. When I click that, now I have an option order here to buy, so +1 quantity, and I can buy more or less. So buy one contract of the Apple April 21st, 160 strike call option. And here's what I pay for it. I can choose my limit price, whatever I want to pay, or I can change this to a market order. I can change it from day to good till canceled, and then hit and send. Now I can't do a market order right now. It has to have a day time in force and the market's not even open. So nothing will happen. But, by clicking the buy button, it immediately puts in a buy order, or by clicking, the ask button, it immediately puts in a buy order here to buy this option. If I click the sell button, I keep saying that wrong. If I click the bid price, it immediately puts in a sell order in order to trade this option. Then I can just come down here, confirm and send, and I will short sell this 160 strike call option. Same thing on the put side here. I have my bid ask column. I just come here and click buy on the 160 strike put. And now I have an order to buy one of the Apple April 21st 160 strike put options. And I can choose my price, time in force, and then confirm and send to send that order. Or conversely, I could sell by clicking on the bid column. And that gives me a sell order, right? A -1 quantity. So I could sell the 160 strike put option to open. Okay, cool. So that's the option chain. That's what it looks like. It's not as scary as it looks at first glance. I know it looks overwhelming. You have all of this stuff, but it's really pretty simple. You have call options on the left. You have put options on the right. Each horizontal row is one option, represents one option contract. And then the individual columns here just tell you things about that option. So this tells me what prices it's trading at now, how liquid those options are, how many people are trading it. And then I have my Greeks here that I like to look at as well. So that's my personal setup. If I go to CB chain layout, this is what I look at: delta, gamma, theta, and then my volume, open interest, and my bid ask. So we'll talk about all of those tomorrow with option pricing and stuff, but that is the basics of the option chain there. Let's get back to where we were. Okay, so tomorrow, we're going to dive into an entire session about how options get priced. This is absolutely critical since it's how we make our money trading options. You have to know what affects the price of an option because this will stop you from having a trade that moves in your favor and still loses money, which is, if that happens, you are trading options incorrectly. So we want to make sure we know how options move and what changes the price of an option so that we know how we should be buying and selling our options. Now, as a quick reminder, after tomorrow's class, I'll be doing another bonus session for VIP attendees only. So tomorrow, for the basic session, I will make sure that we finish by 9 because we have a VIP session to start at 9. So as a quick reminder, if you are interested in attending that VIP session, you do have to upgrade to VIP if you're not already. VIPs get 2 additional live sessions, the ones after tomorrow and Wednesday's classes. So that's 50% more live classes. You get all of the recordings and notebooks, of course, for the VIP sessions. You also get that VIP only Q&A time. You'll get bonus strategies with VIP. You get additional videos. And If you are later wanting to join me in the accelerator program, which is where we trade options together live in the live market, you'll get 20% off the accelerator program, which pays for the VIP multiple times over. So you get a huge discount on the accelerator if you want to trade options live with me later. And that basically, I do that so that VIP people get basically all of your money back for going through VIP plus extra bonus discount for the accelerator if you want to do that. So if you want to join VIP and get all those bonuses and resources, you have to sign up by tomorrow to be in the VIP bonus session. Otherwise, you're not going to get it. So if you want to upgrade to VIP, here's the link to upgrade. This is the direct link. Let me go ahead and copy that and paste it in chat. Okay, so if you want to upgrade to VIP, make sure that you do that by tomorrow so that you can get into the VIP sessions. And that is about it for class today. So I have a couple more minutes to stick around if you have any questions about what we've talked about today. I'd be happy to answer them. Or if you have any questions on VIP or something like that, happy to answer those as well. Otherwise, you are certainly welcome to all have a good night and sign off. And I will see everyone tomorrow evening for day 2, option pricing, and then our VIP session after that. Where exactly was that option customize button? You got it. Oh, Sean, thank you for reminding me about your Thinkorswim question as well. So if you want to customize the option chain here, you go here to your layout button, and under layout, there is customize here. And any of your customized layouts. So if I come in here, I customize this, I add whatever I want. When you hit OK, once you have that, you can come down here and save it. Save it as whatever you want. Hit save, call it whatever you want, and then it will show up down here at the bottom. So I called mine CB chain layout. I think that's a pretty self-explanatory name. So this is the option chain that I like to use. So I saved it as my custom name, so I can always get back to this layout whenever I want, because this is what I use. So that's where that is. It's under the layout button here under customize. Okay, Sean's question about how can you learn Thinkorswim? I actually have a custom video for learning Thinkorswim, or not custom. I have a video that I recorded going through and basically walking you through all of the parts of Thinkorswim and where everything's at. It is more than an hour long, I believe. Thinkorswim is a very broad and a very deep platform. I don't use everything in Thinkorswim, and I highly doubt you will too. You would have to be an everything trader. You'd have to be like a long-term investor, options, rolling, what's it called? Covered call, rolling trader, plus an active day trader to use everything in Thinkorswim, plus a Forex and futures trader. Like it would be crazy to use everything in Thinkorswim. But I can give you a video that gives a brief overview of where everything is at. You can also just look it up on YouTube if you want. There's plenty of people that have talked about Thinkorswim and how it's set up. It's a very popular trading platform, so there's lots of support online for it. If you have any questions on Thinkorswim, I can virtually guarantee you that someone else has asked that question at some point because, again, tons of people use this platform. So there are tons of questions and answers that you can find online, both on Reddit and on YouTube are probably the best platforms to find those things. So if you just want a brief overview of everything, I'm sure you can find that on YouTube. I know for a fact you can find that on YouTube. If you have specific questions on where something is, Reddit is probably your best bet on that. Thinkorswim also has an education session here. If you come to the Learning Center here, there's this How to Thinkorswim, which is a comprehensive guide on how to use Thinkorswim, where everything is at, what everything's in it. So you can read at your own pace here if you'd like. They also have videos on how to do different stuff inside the platform. So you can learn straight from TD Ameritrade here if you want to watch their videos. If you want to watch someone else's videos, again, there's a bunch on YouTube. I've recorded some as well. I don't think they're in the members area for bootcamp, but if you ask Rebecca, I'm sure she would be more than happy to point you to that recording if you would like it. It's not something that we charge for. We've just included it with some other training that we've done. So if you guys want to, I'd be happy to include Thinkorswim in the members area so you can watch that as well. Include Thinkorswim, include the video that I recorded on Thinkorswim there. So yeah, I'd be happy to do that as well. We don't charge for it anyway, so I'd be happy to throw that in there. But again, if you want to, there's tons of resources online as well. Tom asks, does the VIP session include Thinkorswim setting as your screen with indicators? I don't really go over my Thinkorswim settings in bootcamp. We're really focused on the options themselves. And my settings don't have to be your settings or anything like that. I go over some stuff, like I showed you, for example, how I like to set up my option chain. This is an example. These are the settings that I use, right? I look at delta, gamma, theta, volume, and open interest. That's my settings here for the option chain. I don't really go over like my chart indicators or scanners or stuff like that. That's really things that we would do more in the accelerator program, because that's where we're actually doing like live trading together. For the bootcamp, I'm like laser focused on getting you guys up to speed with trading options. However you set up your charts is perfectly fine, right? I'm assuming that people are coming into this with a stock trading background, right? So you've got whatever indicators that you like. You've got your setups and all that. You don't have to use mine. I have what I like, what I have found works for me. I'm sure you have stuff that you like. So I'm not trying to make you trade like me. However you find stocks is perfectly fine. I'm more focused on getting you to understand how to transform your stock trading into options trading, which has nothing to do with your indicators or your charts or anything like that, right? If I was looking to buy Apple right now, I want to make sure that I am comfortable buying Apple right now based on the technicals, and then options are just a way to express that trade. They are not, they're not a substitute for my stock analysis, right? I have to look at this chart and say, yes, I want to buy Apple now. And then the way that I trade Apple is I could go ahead and buy the shares, or I could buy a call option, for example, right? I could sell a put spread or something like that. So I have to make sure that my stock trading is, how do I want to put this? I have to make sure that I would want to trade the stock anyways before I take an option trade, right? The options don't tell me what the stock is going to do. I don't get bullish because of the options, right? I need to do my stock analysis first. Okay, I'm bullish on this stock. Like I've got my indicators here. Everything's green across the board. This would normally be a buy signal for me. So if I wanted to buy Apple, I could buy the shares, or I could buy call options, something like that. So that's the important thing here, is that however you trade stocks, whatever indicators you like to use is more than fine. You don't have to use mine, so it doesn't really matter what my setups are. Which kind of answers your question as well about, will I show you how to set up when you say TTM scanner, I assume you mean the squeeze scanner. The short answer is no. It's really not that hard though. If you go to the scanner, you just add a filter. Should be a study filter. Here, I'll show you right now. You go to custom. You can either, if you know the code, you can type it in here, or go to the condition wizard, edit, go to your study, and then here we can type TTM squeeze, and then you would just look for not the histogram, but you want the squeeze alert as a value. Hold up. Oh, I guess you would want is true or is false. So just a quick point. The squeeze alert being false, I believe, is when there is a squeeze. I remember it's like backwards from what it should be. So I think it's when it's false. You just hit OK. There you go. This shows you all the weekly stocks that are currently squeezing, I believe. Let's double check that. So let's look at Zillow. Yeah, Zillow currently squeezing. So there you go. That's how you scan for it. And if you wanted to, you could just type this in as well. TTM underscore squeeze with the brackets dot squeeze alert is false. So there you go. That's how you scan for it. But no, we're not really focused on the squeeze or like setups. However you get to your setups is fine. I'm assuming you all have a stock trading background. You have indicators you like. You have setups you use. That's great. All I'm showing you is how to structure your trades now with options, so you understand how the options work. The like chart setup, technical analysis is like, that's completely different classes. So this week we're focusing on the options trading side of things, not technical analysis and chart scanning and setups and all that. Those are different classes. Okay, cool. Thank you guys for joining me tonight. Let's go ahead and wrap up there. So I'll be back tomorrow night. I will see you guys then. And yeah, we'll make sure to end the basic class definitely within an hour because we've got the VIP class after that. So again, if you want to join VIP, if you haven't already, there's the link. I'll stick around for another couple of minutes so you guys have a chance to click that link if you haven't joined VIP and you would like to, because we are doing our first VIP session tomorrow after the basic class. So I will see you all tomorrow. Hope you had a great first day, and I'll see you then. Take care.